Good afternoon, it's Christian Thwaites from Brown Janikowski, Tuesday, February the 23rd. We're very lucky and delighted to have here today Professor Robert Heller. Welcome. Professor Heller has a very distinguished career and a very interesting book which has just come out called The Unlikely Governor, which we're going to talk about a little about today. It's called, one of the reasons it's called The Unlikely Governor is that he was a very distinguished member of the Federal Reserve between 1986 and 1989. Spanning both the Volcker and the early years of the Greenspan chairmanship. In addition to your chairmanship at the Federal Reserve, you had a very distinguished career in the private sector, CEO of Visa. You taught at the University of Hawaii, UCLA, you received your PhD from Berkeley, and you've also had a very distinguished career here in Marin on various different non-profit boards and nationally, and also a regular commentator on most of our national press. So we're very proud to have you here today, and thank you for your time, and welcome. There's a lot to talk about, but I wanted to sort of talk a little bit about the background, and then inevitably, because you're an expert on this, the current and Federal Reserve policy. We seem to be in a period of Fed watching again closely, sort of reminiscent of past times. Maybe get some of your thoughts on the other economic policies that are going around today. I know you've written extensively on that. And then just some parting questions about, to bring all your experience to bear. So I know we're going to be running out of time soon, but can I just ask about, your background? You grew up in Germany. How did you get to America, and how did you sort of end up at the Federal Reserve?
Well, that's right, Christian. Thanks so much. I was born in Cologne in Germany during the war, during World War II, just in case we didn't get our wars mixed up here. World War II, and I grew up in a city which was totally destroyed as a result of the war. So we moved around a lot when I was a little kid. And amazingly enough, the United States was always considered as the land of unlimited opportunities as I grew up. So I wanted to see that, and when my girlfriend moved to the United States to attend college, I followed her around. So that's why both of us came to the United States.
That's a tried and tested method.
Exactly.
And you did your PhD at Berkeley, and then, so fast forward, where were you when you got the call to join the Federal Reserve? Do you remember that day?
I was in Japan, actually. I was on a trip for Bank of America, and I was in Japan. In the middle of the night, the phone rings, and it says, "This is the White House calling." And indeed, it was Don Regan, who was at that time Chief of Staff for the President. And at first, when I heard the White House call, I thought it's one of your dumb friends, who's trying to play a joke on you. And he came right out and he says, "Well, would you be interested in being on the Federal Reserve Board?" And I said, "Okay, well, let me think about it. I got to talk to my wife, but yes, we'd be happy to do it."
And what were the confirmation hearings like? Were they as fraught as they are today?
Well, they weren't all that contentious. I'm very proud to say that the end result was splendid. I was confirmed unanimously by the Senate, a rare thing these days.
Yeah.
So the hearings were fairly amicable. I remember there were a few senators who gave me a little bit of grief. Among them, a friend of mine, who I considered a friend of mine because I met him several times before. And but otherwise, everything went well in the end, and I made it.
Well, I think the Fed was very lucky to have you. And just while I do have you, it's a very interesting time. I remember being in the markets in early 1987. I think it was Baker at the time was talking about how the Japanese had sort of attacked the US Treasury market. And then, of course, in the fall of '87, we had a very significant crash, and you were right in the middle of that. Do you remember those conversations and what the Fed did as a result of those?
Well, the October crash was, Greenspan had just come on. Greenspan, I think, had joined the board in August of that year. And so he was brand new on the board. He actually was on a plane to Dallas to give a speech at the American Banking Association conference. And when he landed there, he asked the Federal Reserve person who picked him up at the airport, he says, "Well, how did the markets do today?" And the guy said, oh, down 508. And Greenspan said, well, that's not too bad. And he thought the gentleman from the Fed meant 5.08 points. Instead it was 508 points. When Greenspan heard that, he says, okay, I'm on the next plane back to Washington. And from that moment on, it was sort of pretty much a fire drill. But what the Federal Reserve did, all it did was issue a one-sentence statement. Mm-hmm. The Federal Reserve is ready to provide liquidity in this situation, period. And that did it.
And that is, I think, reminiscent to William Bagehot, sort of in 19th century ways to protect banks, and it worked phenomenally well.
You're absolutely right, Christian. You know, the Federal Reserve has enormous powers, but it should also see the limits of these powers. And, you know, you can't go on throwing money at problems forever and a day. With that, we come to current policy. You know, if there's a problem, yes, you provide all the liquidity that is needed. But then you got to pull it back out again. Mm-hmm. And, you know, that procedure probably in the 87 crash, that probably lasted 3 weeks, 4 weeks or something like that. And we were back to normal. That's the way it should be.
Yeah. And it did very well. So talking about the Fed's reaction in, just trying to take you one more kind of history step, but between sort of 2008, 2009, obviously the enormous credit crunch, the markets were seizing up, people were hearing about CDS and MBS for the first time. What do you think was going through the Fed's mind at that time? And you know, what do you think, how would you sort of rate them on their initial reactions to the crisis?
Well, I think the initial reaction was good because Bernanke at that time, you know, really pumped in money again as it was needed. After that, I think things got a little bit more unconventional, if you want to say it that way. Federal Reserve engaged in one period of quantitative easing after another, blew up its balance sheet to $4.5 trillion, holds now a very major proportion of the entire U.S. debt, and, you know, to what good? Mm. The economy, yes, it has moved forward, but I don't think it needs all this additional assistance. If you listen to the President of the United States, he keeps telling us everything is just wonderful. Things are great. The economy is growing. We have record employment and so on. And indeed, if you look at the objective numbers, they are pretty good. We have 4.9% unemployment, very low. Nobody argues it can get much below that level. We have now, the latest numbers show us 2.2% inflation, where the Federal Reserve wants it, but the last statements from them were always, we got to increase inflation, we got to increase inflation. And that's the biggest, well, I almost said nonsense, that I've ever heard in my life. It's the Federal Reserve's role to preserve price stability and not to increase inflation. That's what the congressional mandate is.
Yes, and they, of course, they have this dual mandate, which is unlike almost any other central bank. Do you think that's a basic problem for the Fed to be able to have to target in both unemployment and inflation? Should they be better off just targeting one?
Well, the Federal Reserve basically has only one tool, you know, and that's the interest rate or the money supply. Pick one or the other which you want to drive. In my days, we were driving the money supply. Nowadays, they focus on interest rates. That's basically one tool. So an economist will teach you in Econ 101 that you can't pursue two goals with only one tool. You need two separate tools in order to get both those goals right. So in my days, again, we argued that inflation is the most important goal, because if you get inflation down, inflation right, you have price stability, then you set the environment for the greatest possible economic growth and therewith the lowest unemployment rate that you can get.
So can I stay on this inflation point for a while?
Certainly.
Because obviously it's
You're in charge.
something which a lot of investors came out of the 70s and 80s, you know, very worried about. So we know that the Fed targets a slightly different number than the headline inflation, but they seem to have a target of around about 2%, and they still don't seem to be getting it. So a lot of Fed governors, both voting and non-voting, seem to be pushing for more inflation. Of course, you've got people at the other extreme like Krugman saying we should be catching up within the inflation that we've missed. So what are your thoughts on the inflation target and whether we're at the right inflation level today?
Look, what you got to have in order to have persistent economic growth and what I would call economic stability, low unemployment and a good economic environment where business can prosper, you need inflation as close to zero as you can get. And Greenspan used to argue always the inflation rate should be so close to zero that it is not a factor in the decision making of the economic agents. Mm-hmm. And I fully agree with that. 2% inflation, think about for a second what it gets you. After 35 years, the price level will have doubled. In a normal person's lifetime, let's say you live 70 years,
yeah,
you have a situation where a dollar is only worth a quarter at the end of your lifetime. So that is not price stability in my book. Price stability means, stable prices, and that means close to zero inflation. Let's not be so scared of deflation. Everybody seems to be totally afraid of it. You look at which one is the most prosperous sector in the US economy right now. What would you say?
Technology.
Exactly. Technology, IT. And in that sector, we constantly see lower prices all the time. A computer that cost $3,000 10 years ago costs $300 now. So an industry can prosper if there is deflation. There's nothing really inherently wrong with it. If it is really fast, too fast, the deflation, like we see last year, for instance, when the price of gasoline goes oil goes down by 70% or something like that. It goes from $100 a barrel to $25 a barrel. Then you get some adjustments in the short term. Some people will go broke if it drops even further. People who are in the drilling business have a hard time, and that will move on. So it's the rapid price movement, unanticipated rapid price movement downward, that is a bad thing. But overall, if prices are stable, or even if they decline in an orderly way, like we see in the computer industry, nothing wrong with that.
Interesting. A lot of savers, I think, would agree with you. So turning to the other mandate, employment, do you think the Fed, we just hit, like you said, 4.9%. Some people talk about the labor participation rate changing, and perhaps there's more slack in the employment market than those numbers suggest. What are your thoughts on where we are with the employment cycle?
Well, at the moment we are in a very sweet spot, 4.9%. You can't get much better. The unemployment rate for college-educated people is 2.5%. So that tells you already what is the way out of unemployment. It is education, a better educated workforce, a workforce that is trained for the jobs that are required in this environment. Where do we find the high unemployment? Among minorities, young minorities especially, you see unemployment rates of 25, 35%. But it's because those people don't have any skills. So that's the way you attack unemployment. It's not the Federal Reserve that can eliminate unemployment by turning on the printing press.
Yeah. So a skills mismatch is one reason for those employment number differentials between the college educated and others.
Absolutely.
Okay. I'd like to come back to oil quickly because there are some arguments made that oil producers, whether it's Saudi Arabia or Russia or Louisiana, are hurting, but eventually those lower prices will feed through at the pump or other energy-related products and make those cheaper and more available. Do you see that happening in the same way as it might have done a few years ago? Do you think there's going to be a beneficiary to the consumer for lower oil prices?
Yeah, I think there are two issues we got to address. First of all, you address the consumer question. Consumer will clearly benefit from it. But we have seen most American consumers putting the money that they're saving at the gas pump, use it to pay off their credit card debt or something like that. So there hasn't been an enormous spending boom. People are cautious. They still have their 2008, 2009 experience in their head. So they are fairly prudent, and that is, I think, all for the good. The second issue that the energy industry, the way we are talking about it right now, has to face is a long-term trend where you have substitution of wind energy, solar energy, alternative energy sources for oil. So, you know, Tesla cars can be plugged in into an electric outlet. Still, what somebody has to generate the energy. Ideally, you know, we have them all run on solar and things like that. But that is a long-term substitution away from oil towards alternative energy sources. And also we have more energy efficient cars. They use less oil, less gasoline than we used to use. So all those factors together are impacting the industry right now. The secular trend away from petroleum energy and the sort of more cyclical thing, you know, what is happening right now in world markets. And don't forget, you know, there was all this drilling for fracking oil, drilling, fracking,
shale gas.
Together, all the shale gas. And the United States now has the largest oil resources in the whole world. And we're actually producing the most oil in the entire world. But that price cannot go down to $5 or $10, you know, it's just not viable.
So do you think there's going to be a consumer benefit eventually?
Well, there's already a consumer benefit.
Yeah.
The average American consumer is profiting very handsomely, you know, and saving a lot of money, no question.
I'd like to come back a little bit to Federal Reserve policy first, and then maybe your thoughts on some of the overseas central banks have been doing some rather abnormal policies recently. But so some people view that the interest rate increase in December was a mistake. What's your thoughts on that?
The only mistake about that increase was that it came 3 or 4 years too late. The Federal Reserve should have increased rates long time ago, normalized the rates, rather than piling on assets onto a balance sheet. Now we have, like I said before, $4.5 trillion on the Federal Reserve balance sheet. It used to be well less than $1 trillion, you know, $700–800 billion. Not exactly chump change, but all that money is excess on the Fed's balance sheet, and eventually you have to reduce it. What else are you going to do? If you have inflation in the United States, you know, we'll turn the country into Argentina or Venezuela. And look, those economies where they have high inflation rates, well, look, they're performing miserably. So anybody who wants to have more inflation should beware not to turn into a country like that.
So they were late in raising rates.
I think they were very late in rising rates. They should have done it much earlier. They should proceed with their last plan that they announced to have 4 increases next year. But the Federal Reserve seems to be afraid of its own shadow all the time these days.
Said that the other day. Yes.
And you know, what do? I mean, they just don't have any fortitude. If Volcker were in the seat there right now, he would have taken action a long time ago.
So we discussed before we went on tape that the rates have actually fallen since then. I think we were at 225 for the 10-year, and today it closed about 175. So what's the market saying, do you think, in reaction to either the Fed or the outlook generally?
Well, I think there are a couple of things again. One important message, I think, is from the Federal Reserve, from the markets, that there's a lot of uncertainty about future economic growth. And because the markets expect relatively low growth, that is a reason why the rates are so low. A couple of reasons for that. One, the US dollar has been strengthened, very strong, very much so over the last year or so. And so that strong dollar means we will be exporting less, importing more, and that should slow down a little bit the US economy. But let's not overdo it. That is perhaps that accounts perhaps for 1/2 or a little less than 1% of US economic growth. So it's 0.5% difference in growth. But we're crawling along at 2%. I have been crawling along the last 8 years at 2%. Normal recoveries have 4% or something like that, with even a couple of quarters in there, 5 or 6% thrown in. So you would expect the US economy to grow much faster, but it is growing slowly. The main reason for that is there's too much regulation, too much uncertainty of government actions. Banks, they don't hire lending officers these days. They hire compliance officers. And, so what does a compliance officer increase the productivity of the bank?
Yes.
It's important to have compliance, but they're not very productive. It's a cost that you have. And the same thing is in every industry. Every industry you can think of. The hairdresser's got to get a license to be a hairdresser. There's an over-regulation of a lot of industries in the United States.
Of which the bank and Dodd-Frank and its various different versions has been probably the most public. We had one of the Federal Reserve, the newly appointed head of the Minneapolis Fed, Neil Kashkari, who ran here for governor last year, talking about too big to fail and more regulation on banks. Do you think that's... What's your thoughts on that?
This gentleman really stumped me. He used to work for Goldman Sachs. He ran for governor, as you say, on the Republican side in California. I thought he was a free market person. Now, there's nothing wrong with high capital cushions for banks, which will protect the taxpayer and which will protect the bank against default. I'm very much for high capital levels at commercial banks. I don't see at all that more regulation helps the banks so much. Furthermore, in the United States, look at all the people who are regulating a bank. There's the Federal Reserve, there's the controller of the currency, there's the FDIC, there's now the Consumer Financial Protection Bureau. For state chartered banks, they're the state regulators that control the banks. So we have, in the country as a whole, we got probably around 60 bank regulators. Now, how can a bank keep up with all that? Very, very difficult, very complex. And they're all making rules. They always have more rules and regulations. But I think high capital levels and an easy touch on regulation, that's the formula to keep the banks safe and sound.
Now, just to sort of briefly switch into politics, not many people are running on that platform, yet probably 30 years ago deregulation seemed to be very successful. Why do you think people are not talking about that more? Is it just unpopular right now, or is it just...
It's unpopular right now because of the crash of 2008, 2009. Now, mind you, it were not really the banks that were the problem in 2008 and 2009. A lot of it was mortgage lending by mortgage banks or non-bank institutions. A lot of them were egged on by the US government. They said, lend to all minorities, lend to the poor, lend to the disadvantaged. And as a result, the banks and the mortgage industry and so on, I'm thinking about companies like Countrywide, for instance, WAMU in Seattle, and so on. They did do a lot of lending and egged on by Congress and egged on by the regulators. And as a result, you see, you saw what happened in the end. So I wasn't very surprised. But then again, I read in the paper today, Bank of America introduces a 3% down payment mortgage in conjunction with the FHA. Well, 3% down payment, that isn't very much. And that doesn't give you, if there's a slight downdraft in housing prices,
they're underwater again.
They're underwater again, the consumers. And look at the housing prices right now in San Francisco, in the Bay Area. They're all very, very high, a little downdraft, and these people will be in trouble. So we are about to repeat our old mistakes.
That's words of caution. I know we're running short of time, but I'd like to just get your view on some of the other central bank policies. So ECB famously said it, various versions of will do whatever it takes. That included their own QE, negative rates. Bank of Japan followed in January. So this world of negative rates that people are talking about, is it as how should we view that? Is it something to fear, or is it something to just have to get through it?
I don't understand it. It's fairyland for me. As we said earlier, I grew up in Germany. I looked at a German magazine last week, and there was a full-page ad by Mercedes-Benz. They will pay you to have a car loan, 3.5%. They will pay you in order to take out the car loan for a new Mercedes, obviously. But okay, I think the negative rates are hurting, obviously, senior citizens. They are hurting anybody who has to save in order to get more money for a house down payment or something like that. They're earning these people are earning virtually nothing on their money. So in my mind, it is also destroying a lot of the middle class and the retired people. How are they going to live? Normal economics tells us that there is a time value of money. You should be rewarded for investing. You should be rewarded for lending money to somebody else so that industry can use that money and prosper. And nowadays, you don't get anything. So,
is it a race to the bottom? I mean, some people call it a zero-sum game. Is that?
Well, there's some central banks that shall we say, they have been at least accused, or it smells a little bit like they want to engage in back-of-the-neighbor policies. They want to get interest rates down so the currency depreciates, and thereby the country becomes more competitive. Again, that's a zero-sum game. What you should be doing instead is labor market reforms in countries like France, Italy, Spain. Most European countries could really benefit from labor market reform, and thereby make the country more productive and have higher economic growth.
Thank you. And before we leave the Fed, if it's not too impertinent, I'd like you to imagine you're the chairman of the Federal Reserve. Janet Yellen is off for the week or the month or the quarter of the year. What would be your directions to the rest of the Federal Open Market Committee if you were Federal Reserve Chairman now?
I would say get back to normal. Get the Federal Reserve back to normal, get the country back to normal. So that means interest rates of around, the Fed funds around 3%, somewhere between 3.5% at least. And then you would again be rewarding savers for abstaining from consumption and for investing. That's the most important thing here. And so in addition, you got to get the balance sheet of the Federal Reserve down to a normal size, just like we have to get the entire federal debt addressed. We are having now $19 trillion in federal debt. Just think about it. $4.5 trillion of that are held by the Federal Reserve. Footnote, about $2 trillion of that is mortgage-backed securities. But so a very large chunk of the federal debt is held by the Federal Reserve. The Federal Reserve has become again the handmaiden of the government, and it should be an independent central bank, and it should do what is right for the country and not help them to plug the loopholes. One last footnote on that one. I think in the last couple of months, in December of last year, the federal government passed a law that took $19 billion from the capital resources of the Federal Reserve and transfer them to the regular spending funds of the U.S. Treasury.
You wrote about this in American Banker.
Exactly, and nobody's paying any attention. I called it the federal, Congress loots the Federal Reserve, basically. That is, the Federal Reserve is not the piggy bank of the government. That is the road to ruin in the long run.
Thank you very much. The Federal Reserve is the poorer without you. Just one last question. Your book, which I look forward to reading more in depth, but it's gotten some tremendous reviews, including from Paul Volcker, who said that he couldn't resist turning the pages, and it's also been very, very well reviewed elsewhere. Was it fun to write? Was it fun to sort of go back to your childhood and youth and revisit it and think about it?
Yes, actually, I wrote it for my grandchildren. We were going with the kids back to Germany and the grandkids, and as I say in the book, I lived in a cave, and they wanted to see the cave that Grandpa used to live in as a 5-year-old, because everybody who was 5 years old wants to live in a cave. I actually got to do it. So before we did the trip, I was always talking about, oh, you'll see the house I grew up in, you'll see the cave I lived in, you'll see this, you'll see that. And finally my daughter got fed up and she says, Dad, you're always talking about yourself. Why don't you just write it down and we can read them as good night stories and they'll really fall asleep fast. So I started to write the stories about my childhood, the first 4 or 5 chapters. And as I was writing, then, gee, this was fun. So I just kept writing. And it became the story of my life, and with wonderful pictures in them, by the way.
Yes, I noticed there's some wonderful old collections, and I look forward to reading it. I think once I start it, it'll be difficult to put down. You write in a very lively style, and I've enjoyed your works and your articles along the way. Governor Heller, thank you so much for joining us here today. Hope you'll come back and see us again. And you will be at one of our client lunches, which people have got invitations for in the next week or so. But always very interesting and stimulating to hear your views, and thank you very much for coming today.
Thanks, Christian.
Thank you.